I want to
see you,
talk
Vonnie.
about a different kind of territory, and that specifically is the fixed income territory right now. A lot of people saying 3% is the level to watch on the 10-year. Many more saying 2.95 is already the turning point. What are you looking for?
So I guess when I'm looking at the fixed income market these days, I'm looking at a market that I think has a lot of confusion wrapped around it. And the confusion is around, are we seeing a rise in real rates or are we seeing a rise in inflation? And you can dig that out a little bit of the TIPS market, but I really don't trust TIPS markets for that because I don't like the liquidity there. And I think really the market needs to come to grips with either we're having this big surge in inflation expectations and inflation, or we're actually having a surge in the real economy. We've got some supply side forces that are driving the real return on capital higher and the equilibrium real rate a little higher. If the latter is the case, it's actually pretty good news for the stock market, and we can have higher rates and better stocks. And I kind of am in that camp, even though I don't really think rates have to go that much higher. If it's the former, the inflation issue, then I think, as you pointed out in your intro, or your colleague in London pointed out in the intro, then we have a little bit more of a problem for the stock market. So I really think that's the tussle. I'm not that nervous about the whole thing because I really do believe that the storyline is centered on a better real economic growth story with tailwinds from deregulation and tax reform.
We've been repricing, and I'm talking specifically now more fixed income than anything else, even though I know you're chief market strategist and you look across assets these days. I'm sure you always did. But is this just a small sort of intermediate term repricing, or is this a whole regime change?
No, I mean, in the grand scheme of things, Vonnie, this is what, a 50 basis point move to start the year. We've ratcheted up Fed rate hike expectations a little bit. It's, you know, the debate of, well, are we going to have 2, are we going to have 3, are we going to have 4? I think even some people threw out 5s yesterday. In the grand scheme of things, these are kind of moderate changes based on historical moves in interest rates. I mean, interest rate volatility is still quite low, even with the craziness that we had with the VIX and everything else. And I think it's just a normal machination that you get in the markets, and we'll work our way through it. I think a lot of people as well, if you want to dig into something a little different, a lot of people are focused on supply, whether it's through the deficit spending. I think that got people going, but also just the Federal Reserve's balance sheet contraction and what that means. Who's going to buy these bonds? And the markets have a little bit of jitter around that.